Starbucks stock down a whopping 16 percentage points here today, one of the worst days in Starbucks Corporation's history. Stock is down about 35% in the past year. Supermicro fell over 14 percentage points here today. That stock in the past 1 month is now down 27 percentage points. Skyworks Solutions stock was down over 15% here today. It actually has basically lost all its gains on a 5-year basis now. So basically that stock is flat on a 5-year basis after losing all the gains here today. Estee Lauder stock, a stock that usually they cater to the higher end when it comes to cosmetics. That stock was down over 13 percentage points here today. That stock is down almost 30% in the past 5 years. And we're talking about arguably the most successful cosmetics and beauty company in the history of mankind. AMD stock is now down about 20 percentage points in the past month. It lost about 9% of its value here today. CVS Health just had its worst day since the great financial crisis. Worst day in about 14 years or so. CVS stock was down nearly 17 percentage points here today. That stock is now down almost 30% in the past 1 month. That's a pharmacy chain. Norwegian Cruise Line down over 15 percentage points here today. That stock is down over 23% in the past month. Zillow Group is down 6.6% after hours right now. That stock already this year has lost over 26% of its value. That's not even including the 6% after hours. We got some things to get into in this video here today, folks. Okay, first thing up. Why are all these name brand companies getting destroyed? What is going on with that? Second thing we're going to get into is the Fed. Are they about to make another huge mistake? It's a very important subject we must discuss. And the third thing is what happens from here. I'm going to take you through what the next steps in this process are so everybody understands that. Hey, and I never let you guys know this, but share this video out with a friend or family member if they're at all interested in the stock market, finance, these sorts of things. You might help them out a little bit. Not everybody's into this stuff, so don't share it with somebody if they don't care anything about the economy or stocks or business or any of that. But if you ever know somebody, share it with them out there. They might actually enjoy it and appreciate it, okay? Alrighty, folks. It depends on how you're feeling in this market. You can either hit that like button like a little fairy or you can smash it like the Hulk. You do what you got to do. All I need from you guys, smash that like button. If you're looking to apply to join a private group, get around like-minded investors who have been through these sorts of volatile markets before and through the markets that we're about to go into here, then click the pinned comment down there, apply to join us. You get access to our private Discord chat with the 6, 7, 8-figure members. You can also get access to all my best course curriculums teaching you everything I got up here, okay? All right, guys, so first up here, name brand companies destroyed. Why? What's going on? Well, here's where the story starts. Inflation, there's no debating, finally, after seeing earnings this earnings season, there's no debate anymore at this point in time in my mind that inflation has really hammered the folks that make under $60,000 a year. No debate anymore. People, for a while said, oh, the consumer's good, the consumer's healthy, there's no cracks in the consumer. After seeing these companies' numbers so far this earnings season, you can't make that argument anymore. The consumer is not healthy. Specifically, the consumer that makes less than $60,000 a year in income, okay? And especially households that make less than $100,000 a year in income. Those consumers are not healthy, factually, okay? We have problems all over the place. FedEx's revenue is down over the past year. Now, keep in mind, we're in an inflationary environment, so naturally, everybody's revenue should be up in theory. When your revenue is going down and you're a big global giant like FedEx, that means people are not doing well, okay? It's not just them. UPS, their revenue was down even worse. UPS revenue down over 5% on a year-over-year basis. That's horrible. That's absolutely horrible for a company like UPS. And remember, if we go back a year ago, they were talking about goods recession, and we were in a goods recession, so we were putting it off as, weakness in UPS business model back then. And then you see we're not supposed to be in a goods recession anymore, supposedly, and yet UPS's revenue is down on a year-over-year basis, right? You look at a stock like Caterpillar, you would think Caterpillar should be revenue should be going up. We still got a lot of home building going on, clearing of land. We still got a lot of big projects going on out there. The infrastructure bill and all the money the government's pumping out there, right? And yet Caterpillar's revenues actually went down right? That's pretty, and these are the biggest name brand companies out there. Whirlpool, they make washers, dryers, ovens, refrigerators, microwaves. Their revenue down year over year. You look at Starbucks, revenue down year over year. Now that's one that you're like, how is Starbucks that's one of those that you would usually never expect their revenues to go down for bucks, not bucks, because you say, okay, maybe not as many people are buying homes, so maybe that hurts Whirlpool. You can make excuses for some of these companies, right? For UPS and FedEx, you say, oh, maybe Amazon, their distribution's really hurting. You can make excuses for some of these companies. By the way, the excuses really still don't count. But you could try to. When you've got a company like Starbucks, you can't make excuses. I mean, they sell things that are like $5 and $6, okay? AMD has two business lines, two of their major business lines. AMD has four major business lines. Two of their major business lines are down over 45% year over year. We're talking gaming and we're talking the embedded business. Absolute complete disaster for AMD right now. Only thing that's saving them is some of their AI capabilities and what they're doing in that data center right now. Tesla's revenues down 9% year over year. That's not good. Tesla's a company you should expect to grow almost consistently year in and year out. So what can we tell so far? Okay. What we can tell so far, and this is very important, is the most popular, most important companies that you would expect in the world are having businesses that are just kind of failing right now. Revenue is going down for these companies. And it's not even like most of these companies had exciting revenues at this time last year. That's a more troubling thing. It's like if these companies were coming off of some huge boom cycle last year and their revenues were blasted to the moon, that'd be one thing. And it's like, okay, it was just a come down. No, their revenues were not even that impressive. Look at their revenues last year and their growth rates. You're not going to find things impressive. But then things, in my opinion, elevated. They got even more serious. And it came from Meta and Amazon. And I think this matters significantly. Meta and Amazon both had weaker guidance numbers than what was expected. Both of those companies. Now, when you have two major companies like a Meta and Amazon basically put out weaker guidances, that means they're expecting the economy to get worse in this quarter. And keep in mind, these companies have already seen what has transpired in the month of April. Meta and Amazon would not put out guide numbers under what analysts are expecting unless they're expecting the economy to weaken. And what they're seeing in their April numbers tells them, you know what? Based upon what's going on in April, May and June might not be that good. Okay? And Meta's growth rate, their growth rate for this upcoming quarter should be down significantly from the previous quarter. Amazon's talking about 7 to 11% revenue growth. I mean, they came off a quarter right now where they were growing like 17%. So it's a massive, epic deceleration. There's something going on bad out there underneath things, right? Apple's reporting tomorrow. There's a high probability, I can tell you this before they even report. I'll do Tim Cook's job for them. There's a high probability that their revenue is going to be down for the remainder of this year. This is Apple. This is the big dog. Like, Apple is another one of those that you shouldn't ever really see revenue going down. You're likely going to see revenue go down, and you could see it to go down quite a bit, folks, okay? Now, on top of that, the Fed lags. Well, you should know what the Fed lags are. If you don't know what the Fed lags are, it's essentially the Federal Reserve, whenever they make a move, it takes time for it to affect the economy negatively or positively. So let's say the Federal Reserve tomorrow lowered Fed funds rate to 0%, let's say, right? From where it's at right now, which is like 5.5%. That would affect the economy positively, but it would take some time for it to really play out. Maybe 6 months, 12 months, 18 months, maybe 24 months, okay? Same thing when the Fed raises interest rates. It doesn't just hammer the economy immediately. It takes time. Sometimes it's more like 6 to 12 months. Sometimes it's more like 18 to 24 months. But it does eventually start to affect the economy very negatively or positively. Now, since the Fed's raised rates so aggressively, right, in 2022 and 2023, that's going to have a very negative effect overall on growth over time, right? And so we're seeing now, clear as day also, the Fed lags are simultaneously catching up. While inflation's destroyed households making under 100K a year, the Fed lags are catching up across the board, and you're seeing this everywhere, right? You look at somewhere like autos, this was back in April, there's going to get a lot worse in regards to autos, by the way. Total early April new vehicle supply stood at about 2.77 million units. That was roughly 1% ahead of March's volume, but 46% greater than last year. Days of supply is skyrocketing for almost every single automaker out there, and you're going to start to see a lot of weakness in a lot of automakers, and you could see major layoffs coming later this year when it comes to the automakers, okay? We already seen it play out with Tesla. Tesla feels effects negative and positive before everybody else does. United States existing home sales. Recently, let's call it over the past year, we've been at numbers that are back at the great financial crisis, right? In terms of existing home sales. So that's clearly the Fed lags are catching up to things like autos, things like home sales. There's no debating that, right? Look at a company like RH's numbers that came out a week ago or so. And these numbers out of RH were bad. Revenue was down for the company. Their revenue wasn't even good last year at this time. The revenue last year was down substantially year over year, like off a cliff. And then to see their revenues go down even more, $738 million versus $772, it's just even more troubling, right? And by the way, RH caters to the wealthy. So it's not even like they're counting on, Joe who works at the auto plant makes $52,000 a year. No. Like they're at the higher end. And so that's very, very troubling, right? Now, we also have had a very troubling trend here recently in regards to real wages, right? Wages, money people making versus inflation. This was starting to trend better, which was good, but now we just went the other way on it. Real wages are now going down. Again, for folks out there, you don't want to see that. If we look at inflation, the latest inflation numbers, the latest CPI numbers in March, it was the highest we have seen since September of 2023, right? So about 6 months or so, which is, once again, not a trend you want to see. That means the Fed has to stay higher for longer, which puts us at even more of a jeopardy of a lot of financial accidents. We'll call it that, okay? Now, in regards to CPI, some people, especially when the last numbers came out, they're saying, well, it's only things like insurance and housing and those sorts of things, right? And there's an argument to be made there. But the problem is, if you want to say it's only insurance and housing, okay, guess what people's biggest expenses are? Things like insurance and housing. So when you think about something like that, right, it's still a major issue for folks out there, and especially, once again, households that make under $100,000, which is most households out there, right? Insurance, you're seeing people's insurance rates are going up 15, 20, 25% year over year. It's a major, if you got an auto, right, and you've got to all of a sudden pay 15, 20, 25%. It's just like a massive extra tax on you. And so instead of paying $150 a month for your auto insurance, now you're paying $200. It's $50 a month less. You can pay down your credit card, or you can go out to eat, or do this or do that, and it's month after month after month you're getting taxed. Now, if your homeowner's insurance also goes up simultaneously and your health insurance goes up, it's bad. It's bad, right? Now, in regards to CPI numbers, I don't know if you guys are aware of this or not, but this matters significantly. Borrowing and debt service costs are not included in CPI at all. Some have suggested this is a deliberate omission to make inflation look lower than it really is, as evidence for this point. In fact, from the BLS, changed the definition in 1983 to exclude it. So keep in mind, if we were to have, if the inflation methodology was the same as it was back in like the 70s and early 80s, nowadays we would have probably seen CPI numbers significantly above what actually we witnessed back in the 70s and the early 80s. Just a little food for thought in regards to that. The government changed a lot of data to like make things look a lot better than what they are in reality. Okay, so the moral of this story so far is none of this is good, right? We're getting. I always pay attention to the most to really understand what's going on in the economy. I don't pay attention to the government numbers as much. Government numbers, I'll look at them all, okay. I don't care about any of that nearly as much as I care about companies, especially big dog companies. How are those companies doing? That's what I want to know. How are the big dog companies doing? Because there's no lying, there's no fudge in those numbers. If you're a big dog company and your revenue is down 5% year over year, it's down 5% year over year, and you got to report that. There's no tricks and gimmicks to get out of that one. You can if you're talking about your non-GAAP EPS or something like that, but not revenue. No, you go to jail if you're fudging your revenue in your company. So troubling, very, very troubling overall in regards to that, right? Now, that leads us to the next subject, which is the Fed going to fudge up again? And then we'll get into what happens from here and how to adjust portfolios and those sorts of things, okay? So here's the deal. The Federal Reserve, Jerome Powell, I listened to him talk for like an hour today, right? He can't cut until one of two factors happen. One is inflation has to be defeated. And is inflation defeated? Absolutely not. When is inflation defeated? Best case scenario is probably fall time. Best case scenario. Because just based upon where CPI is at now, you're not going to be able, at least in the next 3-4 months, to say inflation is done, inflation defeated, we won. You're going to, at the best, probably this fall, right? So that's a scenario where he can cut. And the other scenario is where unemployment goes up quite substantially, right? Which, who knows? I mean, unemployment right now is very low, but things could change 6 months from now, 9 months from now, 12 months from now, right? The issue with both of those is it's going to be too late. When the Fed does start cutting and it's already clear inflation was defeated or unemployment's skyrocketing, it's already too late at that point in time. I call this the game of dominoes. And if you watch my channel for a long time, you know what I call this. It's a game of dominoes, right? And just like if you got dominoes all stacked up and you knock over one and it knocks over another and boom, 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 you can't really, you can't stop it until all the dominoes are knocked down. That's the bottom line with that. And so with the Federal Reserve, whenever they do finally cut, right, they're probably going to start cutting too late. And remember, when they do start cutting, they're probably going to cut like babies, probably 2.25, no different than when they started raising rates. Did they just go to start raising rates 200 basis points? No, they did 25 basis points. It was nothing at first, right? And so let's say hypothetically, they start to lower rates in the fall time. Let's just say that, okay? Let's just use that as an example. Okay, they're going to lower rates 0.25. Does that do anything really to help much? No, it really doesn't do a dang thing. So let's say they start lowering rates in 2025, 0.25 is their first move, or even 50 basis points, which would be a big move down. That does nothing. That does absolutely nothing, okay? And so this is an issue, huge issue. And when we look at the Fed, they have a history of screwing up. This current Federal Reserve also has a history of screwing up. And you look at, they always talk about they're so data dependent. The problem is, the data has to be so overwhelming in their face to make a move. It's incredible. They finally started raising rates in March of 2022. At that time, CPI was already 8.5%. And if we were running CPI numbers, the methodology for that, the same way we were back in the 70s and early 80s, there would have probably been a CPI of 15 to 17%. How is that when you just start raising rates? It's not like it just came out of nowhere. We had clear signs of inflation way before that. Talk to even business owners back at the end of 2020. Small business owners even back at the end of 2020 were talking about inflation. And then in 2021, it just started to get out of hand. And they waited all the way to March of 2022 to start raising rates. And did they go, like I said, like 200 basis points, like 2%, 2 full percentage points? No, they went 0.25. And then these little baby raises, and then they finally got serious about it when it was so far out of control, and they're like, oh, it's not going away, and then they do the 0.75s, right? And so this is a little food for thought in regards to that there's a decent probability they're going to go too far and screw this whole thing up. So now what happens from here? I'll explain to you what's going to happen and transpire from here. First thing is, the sleepy market's over, okay? We're going into drama times, and you've already starting to see this play out in the VIX. The VIX is up about 16% so far for the year, volatility index. Things are going to get a lot more volatile. We had a peaceful period there for a bit, right? And when I say a bit, we basically had peaceful period for about a year and a half, roughly, right? After we got through the 2022 drama. I mean, from basically around the end of 2022 through, we can call it the first few months of this year, pretty chill time. Just a time period in the market of peace. We'll call it peacetime. We're going into wartime now, folks. And there's a difference between a wartime market and a peacetime market. And as I spoke about, you're already starting to see it, right? And you're even seeing it in more ways than just kind of looking at the VIX. You're seeing it in the trading action today. I mean, look at the Dow today. It skyrockets up, skyrockets right down. I listen to everything the Fed had to say here today, from their release to what Jerome Powell had to say. There was nothing in there, nothing that was out of the ordinary. He didn't make any announcements about cutting, about raising rates, about any of that. There was nothing that should have made the market that volatile in the end. Everything he said was what I would have expected him to say today, knowing where his stance is and where the Federal Reserve's at. And yet the market is just all over the place. I mean, it was like before he started to speak, if we go back an hour before the Fed release came out, before he even spoke, right? I would say my portfolio was probably down, if we're thinking about the public count was probably down. We can call it probably multi-five figures, I believe, at that particular time. Then Fed release comes out, things start to improve. Next thing you know, Jerome Powell's speaking, and next thing you know, my portfolio was up multi-five figures. I'm just talking about the public count, not even all the portfolios together. Then the market closes, right? Going into the close, and just things fall off a cliff. And public count was down, I don't know, it was maybe down a few $1,000s today or something like that. So we can call it like a flattish day. Like that's literally nothing. And so what for? There was nothing in the release out of the ordinary, and there was nothing that Jerome Powell said that was out of the ordinary. But yet just crazy volatility. That's the market we're going into, folks. This is what it is now at this point in time. We're going into wartime with the stock market. Now, this is not going to end, okay? We're going to have wartime for a while here. Here's the deal. We're now into May, right? There's a sell in May and go away phenomenon. I'm sure some people have already jumped ahead of that, but that causes volatility. Obviously, right? And in a year like this, a lot of people are going to say, I don't really want a piece of this market over the summer. They're going to be very scared. When I say people, I'm talking really about shorter term traders, swing traders, those sorts of folks. Long-term investors is a whole different ballgame. But I can tell you, a lot of these swing traders, short-term traders, they're not going to really want a piece of this market because they don't really know. It's not clear where things are going right now, whether this market's going up or down. People are just kind of, I don't know. We're going to have summertime drama. We almost always have summertime drama. This year will be no different in regards to that. And you look at many times the weakest time for the stock market in general, guess what it is? It's in summertime. A lot of volatility in summertime. You have, the thing is about summer, you have a lot of people take it off, but then all of a sudden they'll jump back in the market, which just causes a whole other batch of volatility because they can't help themselves. They stay out, they're like, I'm not going to be in this, and then next thing you know, something happens, and then they want back in, and it creates this, and then they want back out, and it creates this whole other volatility spell that happens in the market. And you see that a lot of times in summertime specifically. It starts to be drama. Third thing is, do earnings get worse next quarter? I think this is a serious question. This is my main concern about the market is, do companies' earnings get even worse next quarter? And I'm talking for these big name companies, the Starbucks, the FedEx, the UPS, Apple, Tesla, Caterpillars, these sorts of companies. Is it possible that things could get even worse for them? Because here's the thing. I feel like the market's kind of writing this particular quarter off as maybe just a one-off. If you get back-to-back quarters, and let's say their businesses decelerate even more, and their revenues go even more negative. So let's say you got a company, their revenues are down 3% year over year. If all of a sudden that company next quarter is talking about 6% down, and then their guidance sounds bad and their conference call sounds bad, ooh boy, then you can't ignore that anymore. Then the market goes into total freak out mode about, oh shoot, it's coming. It's actually here maybe, the recession, right? That's kind of total freak out situation. Fourth thing is, now we're going to have this dilemma of inflation versus unemployment rate, where people are going to be, I've already started to hear, I brought up this term months ago, stagflation. Now I'm starting to hear it more and more on CNBC and these financial outlets talking about stagflation. And if all of a sudden you start to see that inflation rate tick up, and all of a sudden it gets to like a 4.2 or 4.3 or 4.4, if that were to play out simultaneously with inflation, that let's say CPI keeps coming in the 3s and it won't go down, never mind if it goes in the 4s, but let's just say it's in the 3s, that could cause a bad dynamic for us, right? And then we got the election coming up. And I know a lot of people aren't focused on election right now because it seems like it's a long time away. Not that long away. The election's what? 5 months away, 6 months away? It's not that long in the future. It'll be here before you know it. That's going to cause a whole bout of volatility in regards to that whole situation. I can tell you that. And it's going to be a messy, messy election. So we're going into wartime on the stock market, folks. Wartime. Now, what type of companies do you need to be invested in and need to be buying in this sort of market? Because keep in mind, for the last really like 18 months, we've kind of been in a peacetime market. And in a wartime market, different companies kind of cut the mustard for that particular time period, okay? And especially when you take into account, no one knows what the Fed's up to. No one knows when the Fed's going to start cutting, when they're going to cut. It's impossible to predict. We've been trying to predict that for a year plus, and no one's accurate in that. And so, that's out there. We don't really know where the direction of the Federal Reserve is, right? Now, you've got to be finding profitable companies in this sort of environment, right? This is where the main emphasis should be put in terms of buying of assets in this sort of market. Profitable companies that have strong earnings per share, net income. There's no all of a sudden they start losing money or something like that. Not in this sort of market. Not when you're going into a wartime market. Second thing is balance sheet is so important. The Fed, there's a lot of hopes going in this year. The Fed would start lowering interest rates, which would help companies out. We don't know about that now at this point in time, guys. No, if we have a situation where the Fed waits to lower rates too long and we get into a recession, some companies that are making profits right now could actually start taking losses, which could hurt their balance sheet even more significantly because they might have to take out more debt, right? If they could even get access to that debt. Also, it's harder to raise capital from your shareholder base if you're going into a recessionary environment. So you've got to stick with companies that have good balance sheets, companies that are earning a lot of interest income right now because they should be, and companies that are not cost themselves a fortune in terms of interest expense. Because if you're buying a company that has huge interest expense because they're loaded up on debt and they don't have much cash, well, you got to prepare for a Fed that might be up here at these 5.5% rates for another 3, 6, 9, 12 months. And so that continues to weigh on that company, right? And then if the Fed does start lowering, it's probably because the economy is getting worse, which could also negatively affect the income statements of companies, right? So you want to find great balance sheet companies in this environment. Third thing is, you got to buy companies that can handle any sort of economic situation because we don't know what we're going into now at this point in time. Based upon these companies' earnings and based upon the Fed has no clue where we're going. They don't. They just don't. You've got to be ready for any type of economic situation. You got to be prepared for stagflation. You got to be prepared for recession. You got to be prepared for inflation to stay a problem, but unemployment low, so it's not really stagflation. It's just still dealing with inflation and high rates, right? You want to be in companies that can handle any sort of economic situation. There's plenty of them out there, right? Proven CEOs, you got to have good leadership in war times in regards to the stock market. Proven CEOs matter. Also, proven the ability to pivot, which is a very valuable skill. I like management teams that are able to pivot and say, you know what, this isn't quite working over here. We're going this route, right? You've seen that you've seen that with companies like Meta, for instance, right? And Zuckerberg pivoted and saying, hey, we need to go this route. We need to go that route. Not all CEOs can do that. There's proven CEOs that are good executors of their business model, but not all those same CEOs are proven that they can pivot on a dime and say, we need to go this direction. Let's go over here. Let's do this. We got to cut these employees. We got to do that. I mean, when I think about CEOs that are some of the best at pivoting their businesses, I mean, two that come to mind are Musk and Zuckerberg. And I understand they can both get hate at different points in time, but those guys, they know how to pivot. They know how to say, you know what, things aren't quite working out over here. We're going a different route. They're not afraid to make employee cuts. If they got to make employee cuts, they'll handle their business the way they got to handle their business. And the reason those guys really have it like that is because they've watched their businesses grow from 100 employees, right? From the ground floor. They've watched those companies grow from the ground floor, so they have a different view on it. And sometimes people say, you know what? I heard this criticism of Elon Musk. They said, he's not empathetic enough, right? He doesn't show enough empathy when he makes job cuts and those sorts of things. Well, he's got a different view. He started that company from the ground up. He started that company when they had no employees. So you just got to understand it's a very different view. Musk shows much more empathy, but then at the end of the day, you can show this, you can show that. You don't know what's manipulation, what's not manipulation, who's really got in their heart. I mean, at the end of the day, what do you want, somebody to cry on camera? Like, you can do that. It's just like, I don't know. You got to have the proven ability to pivot. You got to be more needs-based business models in this sort of environment because, once again, we got inflation that's still an issue. And if we do then get unemployment as an issue, right? Well, needs are even more important. We see people cutting back on more wants. I mean, even McDonald's. I mean, you would think they're kind of like needs-based. Even they've shown some weakness here recently in regards to their quarterly numbers. So, and you got to be careful where you're playing in needs-based. You might think, oh, a CVS is needs-based, right? It's a pharmacy chain. Yes, but they also have other issues that are going on, right? A company like CVS, I would bet you, has a lot of debt, has a ton of interest expense. Higher for longer can put a lot of pressure on them, right? Also, CVS, those type of business models, they're not going to sell stuff for the cheapest. So people might be more inclined to go to Walmart to buy something that they would traditionally go to, we can call CVS for, right? And you also need to be ready to buy dips on any of these big moves because we're going to go through a bout of volatility here. One day it's going to seem like everything's great and your portfolio is skyrocketing to the moon. The next week, all of a sudden, it's going to seem like it's the end of the world, stagflation, another 50% drawdown in the stock market, and there's going to be a lot of fear. And so you got to be ready to add on big dips in stocks you love, in the market in general and those sorts of things. And you got to be patient with it. That's the other big thing. Patience pays big time when you're in this sort of market. Don't get impatient with it. What if we're in a downtrending market for the next year? Are you going to be able to handle that? I'm not saying we are. We could be in a skyrocketing stock market. We get the soft landing, inflation comes down. Next thing you know, we're in the twos, Fed's lowering. Unemployment never goes above like 4.5%. And company earnings start coming back stronger, looking better in the back half of the year. Boom. Next thing you know, rocket ship, right? Russell's rolling, all those sorts of things. You got to be prepared for that as well. But be prepared for a stagnant market. Be prepared mentally for a market that goes up substantially. And be prepared for a downtrending market over this next year. The Fed has no clue what they're doing. Do not count on them to bail you out. They do not know. That's the bottom line with that. And so you got to be mentally prepared for whatever over this next year. This is not a clear time. I think it's a very cloudy, murky time over this next year on what really happens here. And so just be prepared for a range of outcomes. If you're not prepared for that mentally and you think only one outcome is the right one, your one outcome's probably the wrong one. I'll say that, okay? And so just very, very important to understand all those sorts of things I just ran you through right there, okay? Appreciate y'all joining me as always. Thanks so much for being here. Much more of a serious video here today. And once again, if you're looking to apply to join my private group, pin comment down there, fill out an application. We'll see if we can get you up to a much higher level than where you're at. Access to all my course curriculums, Discord chat. Time periods like we're going into now is definitely the time periods that community is good. It's good to be around like-minded investors, other people that are buying the dip, and other people that are, focused on the same things you're focused on, because it's not easy to find that sort of community out there of people supporting each other and excited to buy positions, build out portfolios, and those sorts of things. So pin comment down there. Much love and have a great day.